So it's everyone's favorite time of year again, time to pay Uncle Sam so that he can go out and build roads and improve schools and stuff, right? And the odds are, if you clicked on this video, it's not exactly for leisurely purposes, so let's get straight down to it and figure out how we can save some money on our tax bill this year. You'll notice that a lot of these strategies don't result in more money in your pocket up front, but rather they result in an overall increase to your net worth through the strategic placement of non-tax dollars. I guarantee you're not going to have heard of some of these tips before, so make sure you stick around to the end, and if you find value in this video, please drop a like and subscribe. It really helps me out a ton and it's free to do, so why not, right? The first way to help save money on taxes this year is to maximize your pre-tax contributions to various accounts. I'm sure you've heard this one before. So things like your employer-sponsored 401k or 403b. The only difference between those two is that a 401k is for a for-profit entity and a 403b is for a non-profit entity. In 2023, you can contribute up to $22,500, and if you're over age 50, you get an extra $7,500 to make your total contribution $30,000. So since this money goes in pre-tax, somebody that's over age 50 that contributes the maximum of $30,000 for the year would save around $6,600 in taxes, assuming that they're in the 22% tax bracket. This would also allow you to take advantage of any employer matching that your company offers for participating in the 401k. Outside of employer-sponsored plans, you can always contribute to a traditional IRA, and since this is an individual plan, it doesn't allow you to contribute as much money. It caps you at $6,500 with an additional $1,000 if you're over age 50. These are also pre-tax contributions, so it's going to help set you up for a better future and reduce your tax bill for this year. So those first three accounts that I mentioned, the 401k, the 403b, and the traditional IRA, those are all pre-tax accounts that make you wait until age 59 and a half before you can start withdrawing the money without any sort of penalties. If you want to talk about something that will let you withdraw a little bit earlier, let's talk about the health savings account. The HSA is a little bit easier to commit to, in my opinion, basically just because of how it's used. The money that goes into this account is not locked up until retirement. In fact, you can use it at any point in time as long as you're using it for a qualified medical expense. In 2023, a single person could contribute up to $3,850, whereas a family could contribute up to $7,750. The HSA also allows anyone over the age of 55 to contribute an extra $1,000 as a catch-up contribution. I know the previous ones were age 50, this one's age 55. The money goes in pre-tax, so it reduces your tax bill for this year. You can invest it and grow the money tax-free, and then as long as you're using it for a qualified medical expense in the future, you won't pay tax on it then either. I've already made a full video on this topic before, so I'll leave a link to that in the description box down below. But assuming you're eligible to contribute and use this, why not use pre-tax dollars to pay for your medical expenses instead of post-tax dollars? The second way that we can save money on taxes this year is through using a company structure for strategic deductions. This applies primarily to people that are some level of self-employed. And I say some level of self-employed that way because this is the era of side hustles where you see 19-year-olds all over the place online making millions of dollars per year. So if you have a side income or the potential to make a side income from something you're doing, do a little research to see if you can take some deductions against your overall income. There are some specific situations where you might be in the beginning phases of a new venture that hasn't reached profitability yet, where you might be able to take some of the expenses from the new venture and deduct them as losses against your total income. It's fairly specific, but take a look at this IRS article from 2020 about classifying your side income as a hobby or a business. You might learn that you can deduct some expenses to offset your other earned income. But please remember, I'm not a tax professional and this is just for entertainment purposes, and always consult a qualified CPA before making any decisions about your specific situation. Now getting into the third way to save money on your taxes, assuming that you do have a company structure that you're able to use, let's talk about year-end tax planning. Now, if you do have a company structure that you're able to use, whether it's a partnership, a sole proprietorship, or a corporation, it's important to do some year-end tax planning, ideally with the help of a qualified CPA. The purpose of this is to structure your income and your deductible expenses in a way that lowers your overall tax bill each year, and it looks a little bit different for each type of business. In general, individuals have to pay taxes before they spend their own money. So their cash flow looks a little bit like this. They have their earnings, they pay taxes on it, and then they get to spend whatever's left. But a company, on the other hand, gets to deduct expenses before paying their taxes. So their cash flow would look a little bit like this. They would have their earnings, they would pay all their expenses from the earnings, and then they would pay taxes on whatever's left. Many company structures are considered what's called a disregarded entity, which means the tax liability and profits and losses pass through to the owner. The owners then have to file additional schedules on their tax returns to take care of the tax burden. But year-end tax planning is especially important for C corporations, because C corporations have to pay tax at the corporate level. For example, if you had just estimated that your C corporation would have a profit of, let's say, $100,000 in a given year, but it actually had a profit of $200,000, you could end up in a double taxation situation if you then tried to pay out the additional money as dividends to yourself as the owner of the C Corp. The C Corp would pay the corporate tax rate on the income earned, and then you would pay personal income taxes on the dividends paid out to you. That's why it's especially important for C corporation owners to do their year-end tax planning with a CPA so that they can structure their income throughout the year to allow the company to deduct it. The last thing you want to do as a C Corp owner is to end up in a situation where you're paying double tax. Another tip that only applies to business owners is to consider which method of accounting is going to be the most optimal for your specific business. Most smaller businesses operate on a cash basis, which means they don't pay taxes on the income owed to them until it is actually paid to them. They also don't take deductions until their payables are actually paid out. In this situation, for a small business that uses cash basis accounting, it might make sense to pull forward some of your deductions for the next year before 12/31 of each year so that you can take those deductions for the current year. For example, let's consider a real estate business. This could be a variety of expenses. If there are repairs that you'll have to make in the near future, you can do them by 12/31 to make sure you deduct them in the current year. You could even make your January principal and interest payment to your mortgage company before 12/31 to get more deductions for interest. In my opinion, money in hand is always better than money owed to you. So if you can take the deduction now and get it back on your taxes, I say do it. Getting on to the next tip, let's go back to the individual's state of mind and let's talk about taking advantage of non-taxable streams of income. Let's say you have a Roth IRA and an HSA that you invest in regularly. You choose your investments and let's say you have investment gains throughout the course of the year. Obviously, those are non-taxable inside a Roth IRA and an HSA. But let's also say that you have a large stock portfolio in a normal taxable brokerage account that's grown much over the years. A lot of people would want to take some of those investment gains and use them to do something else like buy and flip a rental property. Instead of selling your stock for a substantial gain and then having to pay capital gains tax on all of that and then using the remainder to buy and flip the rental property, why don't you just take a loan using your stock portfolio as collateral, because that's non-taxable, and then you can buy and flip the rental property and then pay back the loan. You can do the same thing with cash value life insurance. Taking a loan against your cash value, using it as collateral, is also non-taxable because loans are always non-taxable. And while we're talking about stock portfolios, I've got to mention the next tip, which is the benefits of tax loss harvesting. If you've been invested in the stock market over the last couple of years, you've almost definitely got some capital losses that you're sitting on. And if you don't, send me an email because I'd love to know your secret. For the rest of us, we want to take advantage of tax loss harvesting in this situation because if we want to sell some winners and we want to make sure that we don't have to pay capital gains tax on the increase, we want to sell some losers at the same time to offset the gain from this other sale. So let's say I want to sell Tesla for $1,000 gain and I want to sell Netflix for $1,000 loss. The $1,000 loss on Netflix offsets the $1,000 gain on Tesla, meaning I pay zero tax. Just be mindful not to subject yourself to the wash sale rule by buying a similar stock within the 30-day period from the date of the sale. If you do that, then the IRS will not allow you to take the deduction from the original sale. Another tip when it comes to paying taxes on your investment returns is to always ensure accuracy of the 1099-B forms. At the end of each tax year, your brokerage company is going to send you a 1099-B tax form which shows your profit and loss from the previous year. Sometimes these forms will have a missing cost basis from a stock purchase, and then if you sell it during the year, it will look like you had a 100% profit. So that's why you're going to want to review these forms with your CPA each time that you get one if anything doesn't look correct. So let's say you sold a stock for $100 and the form is not showing a cost basis. It will actually show a cost basis of 0, which means you would pay taxes on the full $100 even if you had bought the stock for more than $100. Always make sure that you comb through that 1099-B form before you give it to your CPA. And since I've mentioned it a few times in this video already, my biggest piece of advice to anybody that wants to lower their taxes is to hire a good CPA. It's not always best to try to do things on your own, and in my opinion, whenever it comes tax time, that's a perfect situation to hire somebody that's more knowledgeable in something than you are. The money that you spend hiring a good CPA should not just be viewed as dead overhead costs. It should instead be viewed as an investment into yourself and your business. More often than not, they're going to save you more money than they cost you in fees, and taxes, like many other things in this country, are set up in a way that they're so hard to understand that you either have to spend a lot of time figuring them out or spend money and talk to somebody that's already spent a lot of time figuring them out. So when it comes to taxes, I'm going to spend the money to hire an expert because I know that that's not my field of expertise. I feel like this video could go on for a long time, but I'm trying to keep my videos on the shorter side. So if you have any tax tips that I did not mention, please drop them in the comments below. Be sure to like and subscribe because it means the world to me. I'll see you in the next one.